Hey guys, Freaky Finance here. It's been a little bit. Halloween's always super busy. Anyway, today we're just going to do an easier one. Retail is always easier for me to explain because it's more visual. Just because we're in the middle of earnings season, so it's been super busy. So we're going to do Children's Place. It's a fun one. Basically, a retailer screens relatively cheap if they can get back to what they used to do before COVID. So you can see here, Children's Place obviously targets kids for most of its revenue. They also have pajamas, PJ Place for, I'd say, families, but largely a younger apparel focused. They have a Gymboree brand as well. They have Sugar and Jade, which is supposed to be their tween exposure, so for young teenagers, for older teenagers, and then you have the PJ Place. One of the fun things about this one, maybe I'll try to get some themes about Christmas. Most for this one, we have Mariah Carey starting with Children's Place, so we should see that ad over the holidays. We also saw Snoop Dogg. Basically, what they're trying to do at Children's Place is they're trying to target the young moms. They're just targeting like the Gen Z moms and millennial moms, the people who would shop for kids at this current point in their life cycle. And so far, they've been pretty good about doing it. And we'll talk about their Amazon strategy, one of the reasons why they're not your typical brick and mortar business. You can see here again, target audience is kids. You can tell on the website. In terms of the actual business, one of the things I like about this is that they are in hardcore closing mode in terms of store count. You might be like, well, that's kind of scary. It is and isn't. They're doing it because they're pushing a lot online as much as they can, and they're trying to make that turn. And it looks like, relative to other, I'd say, smaller businesses, this one, I'd argue, has already made the turn, or at least it looks like they're going to. Online sales are there and the engagement is there, so they're doing something right there. That doesn't mean it's going to continue, but it looks interesting. I guess I should, before I keep going, I do own this one. Here, I'll just blow this up. They report on Wednesday, so I want to get the video up before then to revisit it. It trades down, because this would be one that I'd like to buy just a little bit cheaper. I've started fifth position, and I'm hoping to get more as they get cheaper. I have quite a bit going on in retail lately, more than usual. It just, retail is starting to get cheaper, then it pops up, and then gets cheaper again. So I'm trying to get into ones where I think they overreact on the downside, or if they go too much on the upside, I just sell and I just kind of garden it. It's a very volatile market, so we're getting lots of big moves in relatively short order, up and down, which is good for my strategy. Well, before we jump into the numbers, we should keep talking about the business a bit. Largely in Canada, largely in the United States, and a little bit in Canada. Slightly more than 10% of stores in Canada. You can see they're closing an aggressive amount each year, about 10% of the underperforming stores. And importantly, though, the sales have been able to hold up relatively well despite such a sharp decline in stores. aka they're able to make the revenue bridge by going online. So they have a good formula here and a good track record. So I guess, where do you get their revenue? We know they sell them in the States and they sell in Canada. You can say largely from Bangladesh, Ethiopia, Cambodia, Vietnam, India, Indonesia, and China. Only Bangladesh accounted for more than 50% of their production. So again, it's another one where they make stuff overseas and then ship it to North America. We've seen this with almost all the retailers, especially on the apparel side. It's just the only way you could compete in today's market is by doing that. Anyway, in terms of property, this isn't a property play like Kohl's or Macy's could be, which I also own right there, which are also fun plays in their own. I'll probably do a Macy's video at some point if it keeps getting cheaper. Anyway, they do own one distribution center, but everything else is leased. It's not a property play at all, but they do own one, and it's in Alabama. But again, it's not a value play. This is, or a property play rather. It is a value play, but it's not one that requires any property value to unlock it. It's just an extra good, nice to have. So their strategy, again, product, they're all going to say product, every retailer does that. But what I like here is the digital transformation, especially on the Amazon side, which could be a double-sided sword for some, right? Because if you're on Amazon, that means you could say that you rely on Amazon, and then why doesn't Amazon undercut you with their own Amazon Essentials line? Which could happen here, right? So right now they're a partner with Amazon and they're growing well on Amazon, but that could be a long-term risk, right? Here you can see less than 30% of revenue is now from traditional malls, which is pretty unique for a brick and mortar retailer to say, especially one that's just, I don't know, 1.5 billion in revenue, 1.6. Can't remember, it's 1.7. But anyway, are they feeling the squeeze on interest rates? A little bit. They do have some debt. and we're seeing that interest rate tick up. We're going from 3.4% to 8.1%, so it's floating on the higher rates and it's getting squeezed there. So part of that does explain some weakness. Now, when we go into the numbers though, it's a pretty fun long-term trend here. Similar, I'm going to go a little bit quicker because we've seen this trend before with retailers, with the COVID being bad and then too good to be true year after the fact or during, depending on what the industry was in. So for this company, for this time, the February 1st, 2021 to January 30th, 2022 was too good to be true. And that shows up pretty well. Like if I were to look across all these metrics right here, you have almost 15% operating margin versus say the long-term trend pre-COVID of, call it 7% operating margin. So obviously over-earning in this period and under-earning during the shutdown period. One of the cool things that should show up to you is that here you can see revenue. Let's just call it average 1.84 billion. You can see the store count go from 1,000 stores to 600 stores, right? So we've been able to maintain a relatively high amount of revenue, well, almost having the stores outstanding, which is, I'd argue, special to this company, or at least I haven't seen it very often, and I can't remember one on the top of my head where I have. What does the share price react the most to? It reacts to rate of change, obviously, and it reacts to operating income. So you can see the peak out here in 2018 at $150 a share almost. Right now it's at 24. And that was on good numbers. And it had a history of improvement going into that number. We are seeing more debt. So one of the things the company has decided to do to boost the EPS is buy back shares, and it's done that through its cash flow historically, but it's also done through, accelerated it through its taking on debt and selling down investments. Now it's pretty much just taking on debt to do it, and that's one of the issues I think with the share price. Not that it's necessarily a horrible thing, it's just it's one of the reasons why the share price is as cheap as it is at this time relative to its historical average. Here you can see free cash flow pretty strong, 127 million average, 130 million average, but they're buying back 170 million on average a year, which is high for this company. This company is currently only valued on the equity side at 320 million. And just for some record here, if I were to add this, the last 8 years that are here, these are annual numbers. The total of these 8 years in buybacks is $1 billion. It's over $1 billion. So this company's only worth 317 million right now, but they've bought back more than $1 billion of themselves over the last 8 years. That's how cheap it is relative to its long-term potential, or historical potential rather. That doesn't mean it's necessarily going to bounce back to these levels, but it tells you the degree of how cheap it is, or it could be. One of the things I like, again here, I have the wow comment. This is just, you can see fully diluted shares outstanding going from 20 million down to 13 million. And this trend's only continued in the latest quarters. They keep buying back more of themselves, especially at these lower prices. They're going to get a lot more bang for their buck on the buyback. And I like that. I like that a lot. So I have two good things here. Now, one of the reasons why it's cheap is the current performance is still bad. Last quarter was bad. But the guidance for this next quarter and the Q4 were actually pretty good. So we'll have to see the report on Wednesday. We'll see for sure, because that's the Q3 is the big quarter for them. It's the back to school quarter, and Mitch told you that to target kids, so it's pretty much the make it or break it quarter for these guys. One of the things I do like is that it looks like they're through their inventory overhang. So we saw a lot of companies over inventory into COVID. And into this last year, they still had an overhang, and Children's Place is finally behind it. So what we're seeing now, finally, is margin expansion on the gross margin line. So we're seeing margin expansion with what may be revenue recovery, but we'll see. Historically speaking, it's been pretty able to turn, call it 130 million in cash flow a year. So we'll see if it can do so again. But it's definitely a friendly shareholder strategy in terms of the buybacks. So it is worth mentioning that they did take on debt to do that. That's what I wanted to say here. It's kind of a long-term trend. And again, you're getting a company that's been able to put up about 84 million bucks a year in the bottom line. That's currently only worth $320 million in terms of equity EV. So it's I'd say it's fairly cheap. It screens cheap on my screener. And if they can start putting up numbers like they did back then, I think this will re-rate higher over time. And if it doesn't, they'll be able to buy back a lot of themselves down here. Here's just a longer term trend, but you can see again, 29 million shares outstanding in 2009, and it's now you can see the share EPS slowly going from 2 and 3 to 5 to 6, right? Going into COVID noise, and you have the huge down year, huge up year, and then the noise year, which we're finally comping. And I think we're actually into easier comps for at least this company. This company dealt with its inventory quicker than others. In terms of share price, we're still pretty cheap. Not quite as cheap as the Great Financial Crisis lows, but we are getting a decent price that's pre-vaccine. So we're getting a price that's before we even knew we had a vaccine for COVID, so that's nice. In terms of what I really like with this one is the digital play with Amazon. I think long term there is that risk that Amazon competes with them, with Amazon Essentials. But in the meantime, I think right now Amazon is allowing them to win, or at least they're definitely partners so far. It's showing up in the numbers. Doesn't mean it's always going to be that way, but right now it is that way. I mean, we're getting triple digits growth year over year. That's 100% or more. So it's a huge lever for them. And I think with AI for ad targeting, I think it's going to be even easier for Children's Place to target their audience all over the world, and hopefully expand that international more. In terms of social media, you can see that they're punching way above their weight. Again, this company's only worth $300 million, and it's competing with the billion-dollar guys, right? So see it out competing Gap, Old Navy, which is pretty special. This is just a fun one because again, it's only worth $300 million, but they've literally returned $1.6 billion to shareholders since the Great Financial Crisis, less than 15 years. And they basically gave back 5 times what the current valuation is. Just tells you, in the big scheme of things, how cheap it currently is. Again, that's partially because the current numbers are still crap. This is them just saying that they think their marketing is being more efficient than it has been in the past. They're targeting the audience that they want to. They're saying that our Q2 acquisition is approximately flat to 2019 with 40% less stores. So that is pretty special. They're basically able to replace their physical brand presence with digital, while saving quite a bit of money in doing that. One of the things that was nice at the end of this quarter is that their inventory was actually down 27% versus last year. So this is an annual number. You can see inventory here was still slowly going up. It actually was higher than this. So anyway, we're actually down year over year in inventory. And so that means we should start seeing margin expands finally. So a lot of these retailers, some of them are still having an inventory problem. Some are still dealing with it. I'd argue this company's finally dealt with it. The last quarter actually dealt with it. And so we should see margin expansion this quarter. And here is them basically saying that we anticipate gross margin will increase by, call it 2 to 3%, reflecting a decrease in input costs. So one of the things I haven't talked about yet is the input of cotton. Cotton input for these guys, we saw this with Hanesbrands and Gildan. Basically, we should see this also improve margins as they hold price. So anyway, this will help margins in the short run as well, especially on a year-over-year basis when cotton prices were higher. Now they are seeing SG expenses also to be down slightly versus last year. Basically, they're saying they have less store count, reduced home office payroll. Now their expenses that they cut. They also expect inventory to be down by low double digit, so more than 10. And it's all good news. And then this is the kicker. So last year, I think I talked about this with Kohl's, with how bad Q4 is. I'm not there yet. We're only going to see Q3's numbers. But say in early 2024, they're going to be reporting against these horrific numbers that they put up last year. Really kitchen sinking the gross margin. So this is just for some context here. They expect the gross profit will expand 13 to 14% year over year in Q4 at Children's Place. And that's not that the business is that much miraculously better. It's just that last year was just that bad in terms of write-down inventory, because so many companies had too much inventory on their books that they had to just promote it to move it. And they also had higher freight costs. Back then, there's a lot of other things. They had higher cotton prices. So anyway, there's a lot of things that are slowly coming back out, and a lot of these valuations aren't correcting yet, at least enough. So we're starting to get a glimpse into the future while still getting some good prices. And I'm hoping there's a 20% short interest on this stock. I'm hoping that these guys just tank it down and I could just buy like a real position get that at a really cheap price. Now it is screening pretty cheap. I think it's in my top 10 for relative cheapness in terms of EV to EBITDA. But I want it in like that nice sweet spot, like top 1, top 2, and then you get really excited. Especially if information keeps getting better, like this guidance was. This is them basically saying we do see a permanent reduction in our expense structure. They believe the digital acceleration will enable us to have less stores, less inventory, less people, less expense, less debt, and less interest as a result of that debt. So that's a pretty sick cycle. We'll see if they can actually do that. So far, they actually haven't shown they've been able to manage inventory better with less stores. They've actually had worse turns that I could see. They need to get better on that. I think that should be easier for them with less stores. So I'm surprised that it's not improving yet. So we'll have to see how this actually looks like, especially as all these COVID reverberations finally fade out, right? This should be the final noisy year-over-year comp. And now it'll just either be a recession or not in the comp, right, for next year. Just more easier to compare against prior periods. You have to remember retail has been pretty much posting recessionary numbers for six quarters now. So we're starting to get some really good prices on fairly, I would argue, cheap earnings and really weak earnings that some companies won't recover, but some will. And I think Children's Place is one that's showing that it can, or at least this guidance tells me that. Under strategy is a good one. We did see insider buying, only $1 million worth on July 5th. Just figure that's worth bringing up. Short interest, I already said, pretty high, 21%. Days to cover is only 5, so it's not crazy. It's not over 10 or anything, but still, you get 21% of the short float. Small. In terms of the guide, this is why I'm excited. So basically, they're saying that they're going to do $5 in earnings power in this back half. I mean, stock's only $24, right? So if you're doing $5 a share in earnings power in 6 months, you're trading pretty cheap. We'll have to see if they can actually do that. If they do that, I think it just gets easier and easier from here on out for these guys. So we'll have to see if they can. Basically, they're expecting still revenue top line pressure, but they're seeing margin expansion. And yeah, I think that's about it. It's a fun one. It was a quick one I wanted to get out before the long weekend. But yeah, have a great rest of your week, and we'll see how this call goes, and maybe I can get even bigger into it. Take care. Bye now.